Good morning, everyone. Today we're going to start with our lesson on portfolio optimization. Now, we need to load some packages, which we're going to use. Quant mode, you know this, we have used this before. QMAO is quant mode add-on. This makes computation and accessing data really easier than just using quant mode. Then we have performance analytics, tidyverse, tidyquant, and portfolio analytics. Now, apparently, some of you are having difficulties with loading quant mode. So what do you do when R tells you that you can't find, there's no package called quant mode? So what you can do is to Google it, QMAO package in R. And the first one that will maybe one one site that will be recommended is this one. Okay, I think this one. Okay, no, not this one. Okay, let me just Google it. The one in CRAN. Okay, QMAO quant mode add-on package in R. Okay, Control Enter. All right, here from the. Okay, this is. Let me type here CRAN. Okay, it's quant mode here, class. So this is GitHub. Okay, it's not here. I'm sorry. Where was that one that I found a while ago? Okay, GitHub class is a repository of codes. Okay, in fact, the writer of QMAO placed or stored his package here for easier access. So there's this one. Okay, not this one. I'm sorry. Let me close this one. Okay, this is PF. Okay, let me just go back. And here, let's try this. QMAO. Oh, that's the same. Sorry. This one. Okay. Quant mode add-on. So it tells us, class, that install the latest version of this package by entering the following in R. Okay. So you can copy this. I'll share this with you. Control C. For those of you who are having difficulties installing this, because we need QMAO. Okay. So try to run that class. And from my experience in the first section, there was still problem with loading the package QMAO. Okay, try that first. Okay, and if it run, it's good. If not, class, there was another site that I found. Okay, which gave this instructions to run this instead. Control C and chat. Control V. All right. So, however, okay, it needs actually it needs this package dev tools. So you may wish to load first dev tools. Okay, so go to packages and then install dev tools, DEVTOOLS, and then install this first, dev tools, development tools. Okay, so once you have installed dev tools, you can now run this one. So this is for those of you who had difficulty with this one. This simply means, class, install that packages quant mode add-on, that the repository of this can be found here, rforge.r project.org. So the package is stored in this site, in this GitHub. However, when we tried doing that, there was still a problem. So we looked for another site, and this one, which is more complete, says that if you still have problems with the QMAO, try this. However, it will need DevTools. So as I said, please install first DevTools, and then after installing DevTools, install everything, this one. Okay, so we'll wait for those of you who have problems with with QMAO quant mode. And then after that class, kindly please, I think there were 2 of you, please inform us if it's okay, you were already able to install quant mode. Make sure that if you go to the packages, QMAO is present, and then just click it in order to make it installed. Okay, let's give your classmates a few more seconds in order to give their feedback if they were able to load this package, QMAO. So once you have installed QMAO, we'll now proceed with the portfolio optimization problem here. Okay, let's first make use of quant mode. You remember quant mode has this very powerful get symbols function. Okay, so here I'm using the function tickers. I'm creating a name. I'll share this in a while in the interest of time. Okay, but just let's just take a look at the code first. Okay, I'm creating this object called tickers. Okay, and this tickers consists of Apple. Notice that they're in quotes. Google, Microsoft, Intel, Amazon, Netflix, Meta, Tesla, and Standard & Poor's, S&P 500. The ticker symbol of S&P 500 is caret and then GSPC. Then we define the start date to be January 1, 2016, and the end date to be December 31, 2024. Then we use this function, get symbols, tickers, which refers to this one, from is equal to the start date, this one, to is equal to the end date, which is this one, and then source is equal to Yahoo. Periodicity is daily, and auto.assign is equal to T, true. It means it will create these objects, Apple, Google, etc. Okay. It will also create this start and end objects, and also the tickers. And these are vectors. The get symbols are your data. Okay. So I'm going to share this with you. I'll share with you once in a while, some codes. Okay, but the rest you're going to have to write on your own. Control V. So let's copy this class, copy it to your code, and then let's run this. Okay, we can run this all together, or we can run this one code at a time. So I'm going to run this all together. Okay. All right. So you can see here that what was created. Okay. So values class, so vectors. Okay. And start, and the tickers object, character vector. Okay. And on the other hand, here, sa data natin, Apple, Amazon, the nine assets class. The 9 assets. Okay. So if you take a look at Apple, for example, let's view this. View Apple. Remember, this is a six columns. Okay, this is 22, 63. Okay, observations, and then 6 columns. The data starts on January 4, 2016, and ends in December 30, 2024. Okay, which is what we requested. It does not include January 1, 2, and 3 because most probably there was no trading on that day. All right. So we have downloaded these assets. Okay. Now, what's good about okay, let me share this with you. Control C and then chat. So this is an explanation of what the PF function is all about. Let's run this class. Control C. Let's look at this. Control V. Going to close this and run this. Control Enter. So this is all about some functions in QMAO. You have this one, make price frame or PF. So they're the same. They will generate the same results, PF. Okay, so if we go to our code again, okay, so take a look at this. This is our function. I'm going to share this in a while. Okay, let me do something here. Okay. Okay. Caret shift 6. Okay. So we have this class. We're using PF, price frame, and we want to get Apple, Google, Microsoft, etc. from, okay, we can rename this as start because we already created that object. And then 2, let's rename this as start and end, right? There. We have them here, class. Start and end. Okay. And then prefer is equal to adjusted. Notice that we're now extracting, okay, the adjusted price, not the OHLC adjusted and volume. And then we have here na.omit is equal to true, and then silent is equal to true. So what are we creating here? We're creating here a frame, a price frame, where you have all the 9 assets. Okay, you have all the 9 assets, and then you only get the adjusted price. Okay, and then let's view this class, view PF. Okay, please quickly tell me what you get, class. Just run this, Control Enter. What do you get? What do you get, class? Kindly write your answer in the chat box. Are you getting the value, the PF object, or are you getting an error term? Your response, please, class. Okay, maybe I forgot to share this with you. Control C. Sorry. Yeah, I think I didn't share it with you. That's why you're not replying, class. Okay, just copy this, class, and and run this and tell me if you're getting the same. What output are you getting? Error. Okay, thank you. How about the others? Okay, error. Okay. Okay, just like me, class, we're getting an error term because something's wrong with this. Let's copy this, class. Let's copy this, Control C and Control V. Now, you recall, class, that this one, okay, this object is already existing, right? It's called tickers. Isn't it, class? Tickers is this one. It's a vector of Apple, Google, Microsoft. So maybe we can, if we replace it here, class, okay, what do you get? So can you please run this and tell me what you get, class? And what's the error message? Okay, so you just copy this and replace the C, the concatenate with the word tickers, because this one is exactly the word, the object tickers. And please tell me, what was the error message that you're getting? What seems to be wrong with this code? class? What error message are you getting? Hello, class. Error message? Okay, thank you, Joyce. No data in that global environment for GSPC. Okay, now this is something, let's say, weird, because when we run this in get symbols, it ran, right? It generated this object, GSPC. Okay, now when we use get symbols in order to get these prices, we had to use the actual ticker symbol of GSPC here, which is caret and then GSPC. Now in this case, okay, so for PF, what happens is that it makes use of, this is quant mode add-on. So it still uses quant mode in order to get the prices. And then from those prices, it extracts just the adjusted. So you notice that when we generate quant mode, when we generate the object GSPC, it's no longer caret GSPC, but that's just that GSPC, no more caret. So that's why we have to adjust this. When we're now using PF, the ticker symbol for GSPC will no longer be caret GSPC, but rather just GSPC. So here I'm creating this object. You may copy the one on top, class tickers 1, and then these are the prices, including GSPC. However, the caret I removed. Okay, so I removed caret, unlike the tickers one above where I had GSPC, because I'm going to use it. We were going to use it with quant mode, with get symbols. But this one we're going to use with PF. Okay, price frame. Okay, this one, price frame. So if I run this class and I use stickers 1 instead, where GSPC does not have the caret. Okay, let's see, class. Okay, same. Anyway, I'll just copy. So create another code chunk. Okay, make sure to run tickers. So I'll run tickers first. I don't have tickers 1 here. Tickers 1. And then I'm going to run this. I'm using tickers 1, not tickers. The difference, class, is that tickers 1, the GSPC does not have a caret. In tickers, the GSP has a caret. And you need that when you're using get symbols. But this one, we're using price frame. Although indirectly, this goes to get symbols. Okay, let's run this and check, class. We do have now your price frame data, your XS object. Okay, may I once again request your comment, feedback, if you were able to get this, class? Okay, I hope you respond. Yeah, thank you. Okay, good. I appreciate, class, you responding fast so that we don't have so much waiting time. Okay, good. All right, and you can see now, let's just double check. Apple 2383,438. What price is that? I'll click Apple. Do I have it here already? Okay, here Apple 23834. Okay, Apple, okay, adjusted 23,83438. Adjusted price January 4, and we got. Let me close this. Okay, 23,834,8. Same thing, right? So what was extracted were the adjusted prices of all your assets, Apple, Amazon, Google. Okay, so it makes sense, class, to make use of QMAO because it facilitates the processing of your documents, of your data. So here, we just, if you want closing, then close, then you just write close here. Okay. So it was able to generate a price frame, an XS object. Okay. If you check class, the structure of PF. So it's an XS object here. Okay. Columns, Apple, Google, source, Yahoo. It's a POSIX CT for the index and adjusted price. Okay, here. So it consolidated the 9 assets very fast. Okay, instead of us getting the individual assets and then getting the adjusted prices for all of this and then combining it. Okay, this one small function and then everything. We were able to save on some some steps. Okay, so once again, may I ask your confirmation class, your feedback, if you were able to get this PF object very fast. Okay, good. Thank you. Okay, all right. Thank you so much, class. Now, we have this class, we have this PF. How do you compute for the log returns? Okay, so I know how to, I know that you know how to do this. So in the other class, they suggested that we create this object, price frame logret, okay, and then we just get the diff log of PF. Okay, why don't you run that class and tell me what happens? If you recall, in order to get the log returns, we have to make use of diff log of our object PF. And tell me what you get here, please. Feedback, please. What are you getting, class? When you create this object PF logret, which is the difference of the log of PF. Okay, feedback, please, class. Very small values. And what else? A very small values class. Those are daily returns, log returns. About the others, class, please, feedback. What do you notice about the first row, class? NA, of course. Okay, I'm not getting a response from the others, please. May I get your response, class? Did you get the same as James? NA yung first row. Okay. Thank you. Waiting for the others' response. How about the others, please? Again, class, request for you to respond faster because a lot of seconds are wasted due to the waiting time. Okay, thank you, Sherry, Miles. Okay, I'll run this class. Control Enter, and there's another object here, PF. It's an XS object. If I click this class, PF here. All right. Now, what did I run? I think I run, sorry, should be view. This one, logret. There. So view PF log ret. We expect that the first row will be NA because the first value here does not have a previous value. Okay, so let's just quickly evaluate this, validate this. Okay, let's use Netflix. This is Netflix. And as you know, class, in order for us to get the log returns, what we do is just get the Netflix adjusted here, the price on day 2, Control C, Control V, and the price on day 1, Control C and Control V. Okay, so what we do is get the log, okay, and then minus the log. So this is the mini class of diff log, the difference of log, the log of the price at day 2 minus the log of the price at day 1. So this will give us the log returns class. That's why we use diff log. Control enter. Okay, a negative 0.0211 to get this Netflix. Negative 0.2113855, exactly the same. Okay, 507.850, just some rounding off differences. Okay, so in order to make use of this data set, of this XS object, we have to remove the NA value. That's why here we run just copy and then just remove the first row, Control Enter, and then we have this. There you go. So no more NA value on the first row. Okay. All right. So I hope you are able to follow along. Now, you can also generate this without having to, without getting the price frame and then getting the diff log. What we can do is make use of RF. So this is another function. This is return frame. So what will be generated is not the price frame, but rather the return frame. So we're creating this object RF. Okay. Use the function capital RF. We're using tickers one, remember? This is where your GSPC does not have caret. From is equal to your start date up to your end date. And then same thing, preferred is equal to adjusted. And the type here will tell us what type of returns, because it can be discrete returns or continuous returns. Continuous returns is your log returns. And if you can see here, na.omit is equal to true, okay, in order to automatically remove the NA. However, you'll notice something here. And then let's view this. Okay. So again, in the interest of time, let me share this code. I have to do this class because we have to cover some more materials. Okay. So what are we doing here? We're using the RF function, which is return frame. And let's run the first two up to view. Control enter. Now you notice that despite the fact that we impose that na.omit is equal to true, okay, it still generated the first NA value. So I don't know why the RF function cannot remove the first NA. But anyway, we'll just remove this one. Okay, that's very easy. Okay. RF minus 1. Okay. And then run this. Control enter. Then that removes your missing value. And this is exactly the same as the first one. Okay. Once again, may I request you to please comment below. Got it? Okay, thank you. The others, please. Okay, good. Thank you. Thank you, class. So you can either go the long way. The long way is for us to, okay, first the long way, class. The first long way is using quant mode to load your prices here. So once you use get symbols, and then it will generate several objects, your assets, your prices, and then you can C bind the adjusted. Okay, just use column C bind to get the adjusted prices. And we said that this is a lot easier. Just use the PF function. And even easier, class, is use the RF function to generate the returns already automatically. Okay, you don't have to get the PF to get the prices. QA and QMAO will do that for us and then generate the returns. Okay, so let's do this now. We now have this returns class, this one. Okay, these are your daily returns. The returns from January 4 to January 5. This is the return from January 5 to January 6 for Apple. Then you have up to Standard and Poor's 500 here. Okay, now let's compute for the portfolio returns. Okay, Control C. I'll just share the notes and I'll ask you to write the code. It's anyway very easy. Okay, so what do we have here? We're now going into portfolio returns. These are the individual asset returns class. Okay, technically you don't have a portfolio returns. You just have the individual assets. When you have a portfolio return class, you're computing the returns by combining the returns of your assets. Okay, as a preliminary example, let's create a portfolio. Let's call it port 1. So this is portfolio 1, and it contains the return using the return frame. Okay, this one, and then just use subset the first two elements here, first two columns. So all the rows and then the first two columns, which means that we're getting Apple and Google. So to simplify, let's just use Apple and Google. All right. So we create this object port 1 and then return frame subset the first two columns, and then let's get the first 6 observations, and then let's view port 1. Okay, please copy the code, write the code, and then please give a feedback, comment on what was generated class. What was generated by this port 1 when we subset RF? Okay, I'll wait first for your feedback before I run this. Okay, for James, data for January 5 to 12. Only January, for the first 6 observations for the head, okay? Okay, that's correct. For the head. How about for the port 1 object? Yeah, that's correct. Thank you, James. How about for the port 1 object itself? What do you have there? Do you have all the assets, the returns of the assets? What returns do you have, class? If you view port 1, what do you get? Okay, thank you. Yeah, you're correct. Only for Google and Apple. Yeah, because we subsetted it. Okay, so if I run this, sometimes my R is Control Enter. Okay, so here you have your first 6 observations, Apple and Google. Okay, as James mentioned, January 5 to January 12, Apple and Google. And then here in your port 1 object class, you have the daily returns of Apple, log returns, and the daily log returns of Google. Only the two. Still the same 2262 observations, but this time only 2 columns instead of this RF, which has all the 9 columns. Of course, you can make it 4 assets, 5 assets. Okay, but for our purposes, we're just using 2 assets first. All right, Then take a look at this. This one, maybe I'm going to, again, the interest of time, share the code. But before I share the code, I'd like for us first to look at the function. Okay. So we're using another package here, performance analytics. And we're going to use the return.portfolio. Now take note, this is not the return of your individual assets. This is not RF. This is return.portfolio. Okay, we're now computing the return not of the assets, but rather of the portfolio itself. So take note, this is our portfolio. And we'd like to compute for the returns of this. This is not done using RF. Okay, this is done using this object, this function. Okay, where is that? Here. Return that portfolio. Okay, and we identify the portfolio. What's our portfolio? This one, port 1. This is our portfolio, Apple and Google. And then we have to define the weights. The weights. So for a portfolio, you have, if you're investing a certain amount there, then you'll be able to compute how much is invested in Apple, how much is invested in Google. Let's assume that it's a 50-50 thing. We could have, of course, given 60-40, etc. But the total should be 100%. So let's maintain a balanced portfolio, 50% Apple and 50% Google. So very simple, just like this, class. Port 1 ret, we're creating this object, and then we're using the return.portfolio coming from the performance analytics package. Okay. And so I'll share this now with you. Control C, Control V. All right, so let's run this first, class. This two, port 1 ret, and let's view it. Control Enter. And then we have here your port 1 ret, class. Okay, so if you see, class, you only have one column here, portfolio returns. Okay, let's validate this, class. This is your RF, right? Okay, let's use the port 1 here. I'm going to copy this. Okay, Control C, Control V. Okay, and we said that this is the return. This is the return of Apple, and then the weight is 50% for Apple. So we just multiply it by the weights. Plus, this is the return for Google times also 0.5. So if the weight were 60-40, you would have multiplied this by 60, 0.6, and 0.4. Since it's a balanced 50-50, so Control Enter, we get a return of 0.01219. And let's see the port 1 ret, 0.012. Okay, move 2 decimal places, 0.01219, exactly the same. Okay, so indeed this is correct. And the function return that portfolio was able to compute it easily. Had we changed this into 60-40, then it would have been different. Okay, 60% would have been multiplied to Apple and 40%, or vice versa. Okay, once again, class, requesting your feedback if you were able to get the portfolio returns, class. Portfolio return, port ret, and it should only be one daily returns, because you are computing the contribution of Apple and Google. So this is your portfolio return for the period January 4 to January 5, etc. Okay, waiting for your feedback, please, if you were able to get it. This one. Thank you. So you can see, class, that we're now being exposed to the QMAO, the portfolio performance analytics, and later on the portfolio analytics. These are very powerful packages that you use in portfolio optimization. So this will be your next case. Your next case will be to generate a portfolio out of several assets. Again, you'll have to generate assets from different Philippine companies. Okay, good. Okay, now we go here, class. The column name of this is portfolio returns. We can change it to port 50 because it's 50-50, okay? Right, I just, you may wish to change the name. So column names of our object port 1 ret will be port 50 ret. So I'll run this, control enter, and then take a look at port 1 ret. So the column is now port 50 ret. I just changed the column name using the call names function. And then this one class, this one. Let's run this, control enter. And what's the meaning of this? Okay, this one I didn't give the description to the other section. I wanted them to answer it, but I forgot to delete it. Okay, it's 22.27%. Now, why did I multiply it by 252? Why times 252? Anyone, please? Can anyone answer? Why did I multiply it with 252? Anyone, please? If I remove times 252, control enter, what will this be? This is the average daily returns, class. That's around 0.088% average daily returns. Now, to convert this daily returns into annual returns, you multiply it by 252. Why? Because there are approximately 252, yes, correct, Daniel, 252 trading days in a year. Okay, so you multiply that by 252, this average daily returns, to get the average, control enter. This is now your average annual returns. You converted the daily returns into annual by multiplying by 252. Okay, so that's 22.27% average returns of your portfolio of 50% Apple and 50% Google from 2016 to 2024. Okay, I hope that's clear, class. Balanced portfolio here, 50% Apple, 50% Google. Now, okay, let's look at this, class. Rebalancing. This is very important. Okay, let me share this first with you. Control C and put it in the chat box. Control V. Oops, too long. Why is it too long? Okay, let me delete the code. Okay, I just wanted to share the notes. Okay. Rebalancing, class. Okay, I wanted to ask you if you have discussed this. A quick question on class. Have you discussed this concept of rebalancing in your other fin subjects, like investments? I don't know what's the name of your investment subject now is. Have you discussed the concept of rebalancing in your other fin subjects? Yes or no lang, please, class? No. Okay, thank you. No. Okay, good. Because this is an opportunity to learn something new, rebalancing, class. May I request you to please open this site? It's a very simple example lang ni Investopedia. But let's just use that. Okay, so this is that article. Rebalance your portfolio to stay on track. So very quickly, class. Okay, these are our key takeaways here. So first here, okay, we can say that the prices of your assets and their returns change over time. Okay, of course. And over the year, the market value of each security in your portfolio will earn different returns. And what will happen is that the weight will change. Okay. So because of the changes in the weight, there will come a time when your portfolio is no longer 50-50. So because the appreciation of your assets are not the same. So what does rebalancing do? Rebalancing a portfolio is a process where you change the weights of your assets in an investment portfolio. So let's say you have Apple and then Google, it's 50-50. Then after a certain time, let's say after 6 months, it's now different. Maybe Apple has gained much profit So the weight now of Apple is at 50, let's say 54%. And therefore, Google will now be at 46%. So therefore, class, it's no longer the 50-50 that you so desire. So in order to make sure that you want that weight, that portfolio at 50-50, you will have to do something. Okay, for example, you can sell some stocks of your Apple and then buy Google. Okay, in order to make it balance at 50-50 again. Okay. However, class, rebalancing costs. Okay, there's a cost to that because there's transactional cost, there's documentary cost, okay, of course, when you go through the processing through a broker, a stock broker, may mga cost yun. So rebalancing does not happen daily because that can be very costly. Sometimes rebalancing can be annual basis, or the closest that I have seen is 6-month basis. But monthly basis or quarterly basis might not be a good proposition. It might be an expensive proposition. Okay, but the concept is there, class. Rebalancing is the process of buying and selling portions of your portfolio so that the weight of each asset goes back to the original state. Okay, if it's now 53-47, then you do something. You buy and sell your assets in order to bring it back to your 50-40. So this is an example, class. I want you to read this. Okay. It's easily understood for Fin students. This should be a no-brainer. Okay. So please read this. Okay. And let's go back to our lesson, class. Okay. So for this one, we can ask R to do the rebalancing for us. Okay. All right. So this is our, let me first look at the code. We're creating this object, port 1 rebalance. And then we're again using the return that portfolio from your performance analytics. Same thing, port 1. This is your portfolio of Apple and Google. And then 0.5, 0.5. And then rebalance on months. Okay. So what R will do is that every month, at the beginning of the month, there will be rebalancing. Okay. So let me share this code with you. Okay. Up to this one. Control C. Oops. Sorry. Okay. Chat here. Control V. Okay. Let's take a look at this, class. So we're going to use this rebalance on months. Of course, you can use semi-annual or annual, but for purposes of example, we're just going to rebalance on months. And then we're just going to change the object that we created is port 1 ret rebalance. We're going to change the column name to port 50. Okay, it's 50-50 and then rebalance return. So if I run this, class, okay, so this is now our port 50 rebalance return. If you compare this with the port 1 return, class, this one, you'll notice that the first, up to January, at the end of January, the returns will be the same here. Take a look at this. For the rebalance, January 29, okay, from January 1 up to January 29, it will be the same, class. 0.024664. This one, January 29 is okay, here. 0.024664, the same thing, class. However, when you go to February 1, because there's rebalancing, okay, rebalancing, this is now this is 0.001809, okay, for the non-rebalance. For the rebalance, February 1 is 0.001357. So it's now different, class, because rebalance was done monthly. So after at the end of January, it was rebalanced so that the weight will still be 50-50. So from then on, class, February 1, there will be different returns already between the two. Magkaiba na sila ng returns. So what to do with this, class? We have to compare, class, which is the better performing portfolio if there was rebalancing. Of course, class, this does not take into consideration the the cost. of rebalancing. Okay, so we're going to generate a table of annual performance. So we're going to assume that the we have to we have to R will calculate the Sharpe ratio plus, and then we have to identify the risk-free rate. Let's just assume that the risk-free rate is at 10%. Of course, this might be too high, but just for purposes of example. So if you take a look at this class, okay, what is this object? We're creating this. All port 1 returns. So we're going to combine port 1 and port 1 return rebalanced. Okay, so we're going to combine these two columns, port 1 ret and port 1 ret rebalance. So let's run this first. Control Enter. Okay, did I give it ready? Not yet. So I'm going to share this too. Control C, Control V. Oops, sorry, not there. My mistake. Here. Control V. Okay, so let's run first class. This one. We're creating this object, all the portfolio returns. We're going to column bind, put into two columns. This one, the returns without rebalancing, and this one, the returns with rebalancing. We'll change the column names into non-rebalanced for column 1 and monthly rebalanced for column 2. And then we'll ask R to generate the table of annualized returns. Okay, so we have to identify the risk-free rate because this will be used in computing for the Sharpe ratio. Okay, because the Sharpe ratio will be generated with this one. And let's assume it's 0.1. However, class, remember that these are daily returns. Okay, these are daily returns so that your risk-free rate should also be daily returns. It's 10% divided by 252 to convert it into daily returns. However, the output here, class, will be annualized. Okay, so if I run this class, these first two lines, Control Enter, then I'll print all port ret here. And then you notice now that this is your return for the non-rebalanced, and this is your return for the monthly rebalanced. So these are daily returns. And then using this table that annualized returns will create returns, annualized returns class. We're more interested in the annualized returns rather than the daily returns. Okay, then take note class, this is assuming that the risk-free rate, this is quite high, okay, 10%, okay, and then divided by 252 because we're dealing with daily returns, but R will compute the annualized returns. Okay, so let's run this. Okay, and then here we have a table class of your non-rebalanced and monthly rebalanced. Okay, if you take a look at our non-rebalanced, the annualized returns is 20.82. For the monthly rebalance, it's 20.99. Standard deviation, it's lower for for the monthly rebalance, which is good. Lesser volatility, lesser risk. Annualized Sharpe ratio, we assume that the annual risk-free rate is 10%. And you can see that the Sharpe ratio, which is supposed to measure your return for unit risk, it's 36.80, much higher than your non-rebalanced. So for this data, you can see that the rebalance, this does not always happen. Sometimes, depending on the period, sometimes the non-rebalance might show better performance. But in this case, for the period, just to put it into context, for the period January 2016 up to the end of December 2024, for Apple and Google returns, log returns, the balanced class, the balanced seem to be performing better. Now you can experiment that the monthly balance be annualized or quarterly. You can try that class. Okay, I leave that to you on your own. All right, so let's plot this. Control C, Control V. Let's plot the charts. And let's run this. Okay. You can see here a plot. Okay. The red one class is your monthly rebalance. And you can see that in some portions here, the red one display higher cumulative returns class. Take note, this is cumulative returns. This is not daily returns. This is your daily returns. Okay, and this is your drawdown. Please try to see what drawdown means, class. This is a very important concept in investments. Drawdown. That, and it's very easy to find out, class, as your assignment. Now, what will happen, class, is I'm going to post a video continuing this, okay, because the next lesson, class, is portfolio optimization. Okay, so let me just share this with you. Maybe just put that in your notes also, Control C, chat, Control V. Okay, so this will be like a synchronous class. Okay, I'll post the video and then please follow along. It will now use portfolio analytics. Okay, so these are the functions, these are the codes, class. So you'll have here some add constraint, you have here some long only, you have the type box, you have minimum, maximum. Please learn this, class, as part of our asynchronous sessions for the week, because actually we don't have much time anymore. But this will be your next case, portfolio optimization. And the end with the end goal, class, of doing the efficient frontier. As I said, class, the efficient frontier, you have to plot, in your case, something like this. This is your efficient frontier. So what's this, class? Okay. So this is your, what's this, class? This is your efficient frontier will look like this. Okay, give me a few seconds, class. And this, class, is your efficient frontier, this one, this line here. So this, class, is a plot of all your combinations of weights of your portfolio. For example, say Apple and Google. What we did was 50-50. But you can have 1 and 99. You have 2 and 98, etc. You could have different combinations. And it will be plotted here, class. And this is your return. This is your portfolio return, sub P. And this is your portfolio risk, sigma sub P. And if you notice, class, for all the points here, this one, take a look at this. So let's say this is a portfolio P1. Okay. If you're going to compare it with the other portfolios here, okay, in the same line here, okay, you have portfolios here. This portfolio here, class, this portfolio, this one, if you compare it with the other portfolios here, with the same risk, okay, so this is sigma P1. This is your standard deviation. Okay. They have the same risk. All of these assets here, all these portfolios here have the same risk. Okay. Because they belong to the same line here. This is the risk of your portfolio. However, this asset here on the efficient frontier has the highest return. Okay. This is the return. The others have lower returns here. If you plot here, class, here. Lower returns and the same risk. Okay, so therefore, this portfolio, class, which is on the efficient frontier, performs better compared to the other assets with the same risk profile. Same thing with others here. This, let's say this portfolio here at this point has the same risk as all those assets with this risk, sub 2. And it has the highest return, higher returns, class. This is the return of your portfolio too. So this is what you call your efficient frontier. And this is the end goal in mind of our portfolio optimization. Okay, so reminder, class, for next Tuesday, we'll have our face-to-face exams. Okay, please review your ARIMA. It will not cover portfolio analytics. It will only cover up to ARIMA. Okay, some multiple choice questions and some a little of coding. Okay, please bring your laptop. Okay, and with that, class, yes, James, questions?
Regression lang po for the case study.
Mm-mm.
Okay lang po sir if galing po siyang WSJ, tapos yung data po is in-import directly po.
Philippine data yan, ha?
Yes po, Philippine data
As
naman.
long as it's Philippine and it's within the time frame.
Thank you sir.
Okay, so if you can access it through WSJ, no problem. Okay, wherever you access it, class, as long as these are recognized sources. Okay, so you can do that, but you have to include that in your analysis. You have to identify the source of your data. All right. Okay, thank you so much, class. Last comment, please. Did you learn something today? May isang question pa dito, Jenna, please.
Hi sir. We just changed po kasi yung company namin to Metrobank and China Bank, and we checked naman po yung Excel and there's no the same company with others po.
Metrobank and China Bank. Okay, kasi dapat
Yes sir.
class with the other section, dapat yun ang ano ko eh, kasi may Metrobank na sa, sige, tingnan nyo muna, but please try to find another one, okay? But temporarily, i-approve ko siya, but please find another one, kasi maraming bank sa kabilang section, and dapat walang nagkakapareho sa section 1 and section 2. Okay?
Which bank po yung need namin hanapan ng isa pa po?
May Metrobank dun eh, China Bank yata wala.
Okay sir, noted po. Thank you.
Okay, thank you. All right, class. Thank you so much, or thank you for the patience.
Hello, sir.
Thank you, class.